Hello, welcome back. Today's video we'll be talking about some of the interesting areas within the financial market. So let's go to the first slide, right there, and yeah. So let me just give you a quick idea about all the content in my slide. It's very generic, and it's adopted from various textbooks. I'm just using this for a reference. The discussion will be more to give you a flavor of the concept in the best simple possible way. Okay, so we're talking about financial markets today. So, what comes to your mind when we talk about financial markets? I'm sure the first term which comes to your mind is the stock market. And if you are more into this area, then you will start talking about commodities market, foreign exchange market, insurance market, hedging, and derivatives. So let's look into this whole area, right? So how does it affect me as a person? You might be interested to know, or how does it impact the company, or how does it impact the government organizations or not-for-profit organizations or various institutions within the state and the country. So let's get a flavor of this, okay? So let's look from an individual perspective. So today I have more money in my hand and I don't want to leave them static in my bank. So I want to earn an economic return based on my risk appetite, and I can in that scenario look into various options. So one of them would be a share market, which is a bit risky, but then the returns are quite good if you are able to take high risk. Otherwise, you can go for government bonds, where you can have a low risk, but the rate of return will be low too. So basically, when as an individual I'm in a surplus position, I would think about various venues for investment. So the same applies to organizations as well. Nobody wants to keep the money static. They all want returns. They all want an economic return. But what happens in a firm's position is they have been in a deficit position. For example, they are in need of say $100 million to be investing in a new project, which is going to give them a huge market position. So in that case, they can't really generate the funds internally, or it's going to be too expensive for them to go into the banking institutions and ask them for a loan. So in that case, they might decide to issue some loan bonds into the market, in the share market, and seek some investment, seek some funds from the investors, and later invest them in the projects. Or they can also do an IPO, initial public offering. For example, I think one of the famous ones was Facebook. They, of course, they were not in a deficit position. They just did that because they were going public. So they did an IPO and they issued shares and stocks, and the public invested their money. And it's not a private company anymore; it's a public company. So yeah, so it provides. So when we talk about financial market, share market is a very dominant terminology in the mind. But it's not just that. Let me tell you, it's not just the share market. It's much more than that. So that's what we're going to be looking at in this video today. So, what are the other sort of markets? Of course, the capital market, the share market was what we've been talking about. So, there are other markets like the money market, the commodity market, the derivative market, insurance market, and the foreign exchange market. So, money market would be more for short-term financing. You have a lot of financial institutions doing it, and you have the banks giving overdrafts. So that's the area which the money market covers. And you have the commodity market. So it's not just shares which are being traded also commodities are being traded, agricultural products are being traded. So that's a huge market and has its own demand and supply forces dominant and deciding the movement in those markets. And then we have the derivative markets. It's a very interesting subject because it provides an opportunity for the person who is participating in the first market, it's a capital market, to mitigate the risk, because as we just discussed in the capital market, it's not all rosy. We do have our ups and downs, but the derivative markets give an option for those participants to take calculated risk or to cover the risk. It's more like an insurance, but then you just do it without taking an insurance policy. So we will see how that's being done in the later part of the video. And the next one is a straightforward market. It's an insurance market. So we have, I mean, I'm sure every country has their own major insurance providers for vehicles, for life, for health, medical expenses, etc. So they basically cover for your losses, for your liabilities, and repay back the claims. And insurance companies are reinsured with other bigger commercial organizations to be able to handle large unforeseen claims because they just don't want to go bankrupt. So they also reinsure themselves with huge organizations. And the last one in our video is foreign exchange market. So that's a huge market as well. I'm sure if we all know about share market, the foreign exchange market is the next popular one, I would say, because there's lots going on there and people make a lot of money, short-term gains, short-term losses. So it's more quick. It's more quicker than a share market, I would suppose. So when we talk about these markets, we need to be able to distinguish between a primary market and a secondary market. So primary market is again going back to our example of Facebook. So it's focused from the borrower's perspective. Um, so the organization, the company which is in need of funds, so they are rolling out the IPO, for example, in the case of Facebook, and they kind of roll out their stocks, and the public directly is in contact with the company which is rolling out an IPO, and the funds go into the company. So that's a primary market. It's straightforward. There are no intermediaries, I would say. However, the secondary market is the next stage. It's a casual market where there are several investors, participants, the buyer side, the seller side. It's mostly second-handed trading, and a lot of movements happen. They basically decide the movement of all the stock exchanges. So the market sentiments define how they sell and how they buy or how they hold the uh, securities or the instruments. So that's about the secondary market. So it's more of a freestyle market, but it's happening with its own rules and regulations and legislation. And now let's look into the secondary markets in further detail from an investor's perspective. So, from an investor's perspective, what they get to do is they get to diversify, because if, for example, I have, say, decided to invest $1,000 in the stock exchange on the stock market today, so then I just don't have to restrict the whole amount into one organization because the risk is going to be high. So I have this option to diversify this $1,000 into, say, even 20 other companies. It's very flexible. You can just diversify and ensure that you don't put all your eggs in one basket. So it's a very good strategy. And the next um, uh, and the next benefit for an investor is risk shifting. So even if I decide to invest $200 within a company, then I don't have to invest them entirely into the equity shares. I can split them between equity shares and their debentures. So equity shares is of course high risk instrument with high returns. But if the company doesn't do well, and I can still be assured if I invest some money in their debentures, because it's going to have a fixed return on the investment. So that's another benefit for an investor in the secondary market. And now let's see what's hedging. So hedging is again another strategy. It's more like an insurance policy, as I mentioned to you earlier. So we all know that stock exchanges and share market, it's a bit risky, but even it helps you cover those risks in the markets. It's not just share market, it's also about an exporter. So if I'm exporting from UK and I'm expecting a payment in euro from a French customer, and what happens if euro declines in value? So in that case, I want to counterbalance the scenario, and I want to arrange to sell the euros in a forward manner. So in this way, I'm covering the risk of decline in value of euro. So it's kind of it limits the losses which an organization might be facing. So it's a smart strategy, I would say. And there's another benefit to an investor in the stock market, but it's kind of speculative benefit, I would say, because it's called arbitrage. So in this process, you're able to buy a security at a low price in one market and sell in another market at a higher price to make a profit. This is kind of 50-50 percent benefit, I would say, because it is more speculative, and it is very quick. Anything could happen. So in the stock market or in the commodity markets, any market, you can do arbitrage. So that's one of the profits. But yeah, it is not illegal. It can be done legally. So that's one of the benefits of being engaged in secondary market. Okay, so that's it for now. If you have any questions, please write back to me. So to give you an overview, we just discussed more about the finance markets. And so when we say finance market, it's not just share market. So we have more than share markets. We have commodity markets, foreign exchange market, derivative markets, and the money markets, as we discussed. So it's a very foundational knowledge if you are in the finance profession. If you're in BCom and if you're in M, I'm sure if you're in MCom, you must have done all these. But yeah, you do them in your high school as well. But then it's more with a real. Industry experience that you should start looking into these terminologies and unpack them, so that when you are really going into the real world scenario, it's going to be so helpful. So I think this video has been of help to you. So do write back to me if you have any comments. Thank you so much, and hope you have a lovely day. Let's catch up on another video soon. Bye bye. Have a good day.